Hello everyone, and welcome back to Alpha Market Meridian, your trusted source for daily, data-driven market analysis, trade setups, and risk management strategies. I am Eric. It's April 28, 2026, and today we are breaking down three of the most important assets in the global financial system: gold, the US dollar index, DXY, and crude oil, WTI and Brent. If you're new here, make sure to subscribe and hit the notification bell. Every single trading day, we deliver concise, actionable analysis before the market opens, so you can trade with confidence, not emotion. Today's video is packed with key levels, high probability scenarios, and critical risk events that could swing prices in the next 24 to 48 hours. Let's begin with a quick market overview. Global markets are in a state of cautious suspense this Tuesday, April 28th. All eyes on the United States, where two massive events are scheduled. First, the core PCE inflation data for March, released at 8:30 a.m. Eastern Time. Second, the FOMC monetary policy decision, followed by Fed Chair Powell's press conference. These events will directly shape expectations for interest rates, which in turn drive the dollar, gold, and even oil prices. Right now, markets are pricing a 92.4% probability that the Fed holds rates steady at today's meeting. The real question is, how hawkish or dovish will Powell sound? Will he push back against rate cut hopes, or leave the door open for easing later this year? Across other regions, equities are mixed, with tech stocks under mild pressure from rising rate expectations. U.S. Treasury yields are consolidating near recent highs, with the 10-year yield around 4.35%. Commodities are focused on dollar strength, Fed policy, and ongoing geopolitical tensions in the Middle East, which continue to support a significant risk premium in oil prices. In short, today is a Fed-driven day. Everything else is secondary. Now, let's dive deep into gold. Gold, critical support, resistance and price forecast. Gold has been in a major uptrend over the past 2 years, driven by central bank buying, geopolitical uncertainty, and fears of U.S. debt expansion. But recently, the rally has stalled, and price is now testing a major support zone that could make or break the short-term trend. As of early April 28th trading, spot gold is trading around $4,680 per ounce after dipping to a low near $4,666 overnight. COMEX gold futures are hovering near $4,695, down about 0.96% from recent highs. Key support zones for gold, April 28th, $4,660, $4,650. Intraday low zone. A break below opens the door to $4,600, $4,600, $4,580. Major psychological and technical support. This is the level we highlighted last week as a line in the sand for bulls, $4,520, $4,500. Strong demand zone, where buyers have previously stepped in aggressively. Key resistance zones for gold, April 28th, $4,720, $4,730. Near-term supply zone. Overnight high and recent consolidation top $4,780, $4,800. Critical resistance, a break above. Signals a potential retest of all-time highs above $4,900, $4,850, $4,900. All-time high zone, last tested in late March. What's driving gold right now? Gold's price action today is dominated by two forces. First, the US dollar and real interest rates. Gold is a non-yielding asset. When real rates rise, meaning nominal rates minus inflation expectations, gold becomes less attractive compared to bonds. Right now, markets expect the Fed to keep rates higher for longer, which has pushed real yields up and pressured gold. Second, institutional positioning. SPDR Gold Shares, the world's largest gold ETF, has reduced its holdings by 1.2 tons recently, bringing April's total reduction to 28 tons. Meanwhile, speculative net long positions in COMEX gold have fallen to a 3-month low. This shows that large investors are reducing bullish bets ahead of today's Fed decision. 2 scenarios for gold today. Scenario 1. Hawkish Fed, 60% probability, core PCE inflation comes in hotter than expected, and Powell emphasizes higher rates for longer. Dollar strengthens, real yields rise further. Gold ** breaks below $4,650 **, targets $4,600, then $4,500. This is the bearish case and aligns with current institutional positioning. Scenario 2, dovish Fed, 40% probability, core PCE is in line or cooler than expected. And Powell acknowledges slowing inflation and economic risks. Dollar weakens, real yields fall, gold ** holds $4,650 support **, rebounds above $4,720, targets $4,800. This is the bullish case and would trigger a short squeeze in gold. Trading strategy for gold, April 28, bullish setup. Wait for a clear bullish reversal candle above $4,700 with confirmation from a weaker dollar. Target $4,780 to $4,800. Stop loss below $4,640. Bearish setup. Sell on a ** break and close below $4,650 * with dollar strength confirmation. Target $4,600, then $4,520. Stop loss above $4,720. Neutral traders. Stand aside until after the Fed decision. Avoid overtrading in choppy pre-Fed conditions. The big question, can gold hold the $4,600 level? The $4,600 zone is make or break for bulls. A sustained break below would signal a deeper correction, potentially down to $4,400 to $4,200 in the coming months. A hold and rebound would keep the long-term uptrend intact, setting up a retest of all-time highs later this year. Now, let's shift focus to the US dollar index, DXY. The US dollar has been on a strong rebound since mid-April, driven by resilient US economic data, hawkish Fed rhetoric, and safe haven demand amid global uncertainty. Today's Fed decision will determine whether this rally continues or finally runs out of steam. As of early Tuesday, DXY is trading around 105.20, near the upper end of its recent consolidation range. Key support for DXY 104.50, 104.30. Near-term support, recent consolidation base point 103.80, 103.50. Strong demand zone. A break below signals a trend reversal to the downside. Key resistance for DXY 105.50, 105.70. Immediate supply zone. Recent rally high point 106.20, 106.50. Major resistance, 2026 yearly high zone point 107.00, psychological level, last seen in late 2025. What's behind the dollar's rally? Three main drivers. First, the Fed's hawkish pivot. After inflation re-accelerated in Q1 2026, Fed officials have shifted from talking about rate cuts to keeping rates high or even hiking again. Markets now price zero rate cuts for 2026, with a small chance of a 25 BP hike by July 2nd. U.S. economic resilience. Recent data, including strong jobs growth, solid retail sales, and sticky core inflation, shows the U.S. economy is avoiding a recession so far. This makes the dollar more attractive relative to other major currencies like the euro, which faces slower growth and more dovish ECB policy. Third, global safe haven demand. Geopolitical tensions in the Middle East, ongoing Ukraine war concerns, and uncertainty around China's economic recovery have kept the dollar's safe haven bid alive. The critical question, where does the dollar's rebound end? We believe the dollar's rally is in its late stages, but one final push higher is possible if the Fed sounds hawkish today. Hawkish Fed. DXY breaks above 105.70, targets 106.20 to 106.50. This is likely the final top for the dollar in Q2 2026. Dovish Fed. DXY reverses below 104.30, signals a trend change to the downside. The dollar could fall back to 103.00 to 102.50 in the coming weeks. Trading strategy for DXY and dollar-correlated assets. Long dollar, only if price breaks above 105.70 with hawkish Fed confirmation. Target 106.20. Stop loss below 104.80. Short dollar. Look for bearish reversal signals below 104.50 after a dovish Federation target 103.50. Stop loss above 105.50. Gold, euro to US dollar, pound sterling to US dollar. These assets are inverse to the dollar. A hawkish Fed pressures them. A dovish Fed boosts them. Now, let's move to crude oil, WTI and Brent. Crude oil, WTI Brent. Geopolitical risk, supply and demand, trading opportunities. Crude oil has been trapped in a range for months, caught between bullish geopolitical risks and bearish global demand concerns. Today, we break down both sides of the argument and identify high-probability trade setups. As of early April 28, WTI crude, $83.50 per barrel. Brent crude, $87.20 per barrel. Bullish drivers for oil. 1. Middle East geopolitical premium, $10.15 per barrel. Tensions remain extremely high in the Red Sea and Persian Gulf. Houthi attacks on shipping continue, while the risk of direct conflict between major regional powers remains elevated. Shipping traffic through key waterways like the Strait of Hormuz has dropped sharply, raising supply disruption fears. This has added a permanent risk premium to oil prices that could jump higher at any time. 2. OPEC Plus production cuts. OPEC Plus has maintained its 1.2 million barrels per day production cut into Q2 2026, supporting prices. Saudi Arabia has also extended its voluntary 1 million BPD cut, keeping supply tight. 3. U.S. stockpile draws. Recent EIA data has shown unexpected draws in U.S. crude inventories, signaling stronger than expected domestic demand, bearish drivers for oil. 1. Global demand weakness. The International Energy Agency, IEA, and OPEC have both warned of slowing oil demand growth in 2026, driven by a weaker global economy, China's slow recovery, and energy transition policies. 2. U.S. shale oil resilience. U.S. shale production remains near record highs, limiting upside potential for prices. 3. Strong U.S. dollar. A stronger dollar makes oil more expensive for global buyers, weighing on demand. Key levels for WTI crude support, $81.50 to $81. Recent consolidation low, $79 to $78.50. Major demand zone, resistance, $84.50 to $85. Near-term supply, $87 to $87.50. Recent high, key levels for Brent crude support, $85.50 to $85, $83, $82.50 resistance, $88.50 to $89, $90, psychological level, geopolitical risk evolution. What to watch. The biggest wildcard for oil remains Middle East tensions. Any of the following could trigger a $5.10 per barrel spike in hours: a major attack on oil infrastructure in Saudi Arabia or the UAE, further escalation in the Red Sea disrupting more than 10% of global oil shipments, direct military conflict between Israel and Iran. Conversely, any de-escalation, such as a ceasefire agreement, could trigger a sharp pullback, as the geopolitical premium is priced out. Trading strategy for oil, April 28, range-bound play. Buy dips to $81.50 to $81, WTI, with tight stops below $79.50. Sell rallies to $84.50 to $85 with stops above $86.00. Breakout play. If WTI breaks above $85 on geopolitical news, go long targeting $87. If it breaks below $81, go short targeting $79.00. Risk management. Oil is extremely volatile due to geopolitics. Use smaller position sizes and wider stops. Summary and critical risk reminder. Let's recap today's key takeaways for April 28, 2026. Gold, XAU USD, key support, $4,660 to $4,650. Critical $4,600. Key resistance, $4,720 to $4,730. $4,800. Bias, neutral into Fed. Hawkish equals bearish, dovish equals bullish big question. Can a hold $4,600 US dollar index, DXY, key support, 104.50 to 104.30, 103.50 key resistance, 105.50 to 105.70, 106.50 bias, late stage rally, hawkish equals final push, dovish equals reversal big question. Where will the rebound end? Crude oil, WTI Brent, key. Drivers, geopolitical risk premium versus weak global demand WTI range, $81.00, $85.00 bias, range bound with geopolitical upside risks big question. Will Middle East tensions escalate or de-escalate? Critical risk reminder today's Fed decision is high risk. Volatility will spike. Do not over-leverage. Always use stop losses. Trade only the best setups. Final thoughts and interactive question. Thank you so much for watching today's analysis. If you found this valuable, please like, subscribe, and share this video with your trading friends. Now, let's interact. What do you think gold will do next? Will it hold $4,600 and rebound, or break lower? Drop your price target in the comments below. I read every single one. This is Alpha Market Meridian. Trade smart, stay safe, and we'll see you in the next one.